Hi, welcome back to my channel. In this video, I'm going to be talking on how to apply proper risk management on your capital when trading. Basically, it all comes down to the fact that the reason most traders blow up their account isn't really due to poor strategy, but lack of proper risk management. You can have a strategy that has a win rate of 40%, but as long as you follow proper risk management, you won't blow up the account, rather, you will be profitable. So in this video, I'm going to show you how you should be trading, and what lot size to use in order to stop blowing up accounts. First of all, let's talk on the requirements. The first thing to take note of is that you need to have a strategy that has a minimum win rate of 40%, which implies that for every 10 trades you place, you want a minimum of 4 trades to return profits. Always remember, no strategy is 100%. Let's illustrate this. If you have a $50 capital, under the condition that our strategy has a win rate of 40%, we're expecting 4 winning trades and 6 losing trades for every 10 trades. This is where our risk management comes in. Number 1, your stop loss should be a minimum of 15 pips and a maximum of 20 pips. This is where most traders get it wrong. You should not be using a stop loss of 5 or 10 pips. You will definitely get burned. You should not also use a stop loss of above 20 pips. You have to understand that it's okay to lose. Stop loss is basically saying, if the market goes against what I planned, I want to get out here. Number 2 point to take note of is that your target should be a minimum of 1 to 2 risk to reward ratio. And the last key point, don't trade with more than 5% of your capital. Now let's draft this out assuming we have a capital of $50. First of all, we're not trading with more than 5% of our capital. So 5% of $50 is $5. To get this right, you need to know what lot size to use first of all. We can calculate that using this formula, which is the amount we want to risk per trade, divided by 10 times the number of pips for stop loss. In this case, we want to risk $5 per trade and we're using a 15 pip stop loss, times 10 which is 150. So this is the lot size we are gonna be using per trade. Now that we know what lot size to use, next, let's calculate our profit and loss for each trade. The formula to do this is 10 times the lot size, times the number of pips, whether take profit or stop loss. Let's calculate our winning trades using this. Under the condition that we're targeting 1 to 2 risk to reward ratio, in this case, we are using a 15 pip stop loss and a 30 pip take profit. For our winning trades, we have 30 times 10 times our lot size which is 0.03, which is 9. So for 4 winning trades we are on a profit of $36. For our losing trades, we have 15 times 10 times our lot size which is 0.03, which is 4.5. So for 6 losing trades we are on a loss of $27. With this, our total profit minus loss is 9. So at the end of the day, we ended up with $9 profit instead of blowing up the account. That's the illustration on how to apply risk management. Also, ensure your leverage meets up to open a lot size you would be using. The cool thing is the higher your win rate, the more profitable you become, and always remember, there is no 100% strategy, there will be losses. Don't try to revenge a losing trade, rather aim at identifying where you went wrong and improve on that. Doing that, you become a better trader. That's it for this video. In the next video, I'm going to be talking about what to do and what not to do when trading. So subscribe to this channel to get updates when I release a new video. And I'll see you in the next video.